Welcome to Market Pulse. We're going to cut right through the noise and break down the key questions that are really driving the markets right now, from the AI frenzy to the S&P 500 and even Bitcoin.
So, here's what's on the docket today. We're hitting 5 critical areas to give you a really clear, data-driven picture of the financial landscape. Okay, let's jump right in.
All right, let's start with the big one. The question that's on pretty much everyone's mind. Is this explosive growth we're seeing in artificial intelligence sustainable?
So, is this all just a speculative bubble waiting to pop? Well, when you actually dig into the market data, the answer seems to be no. It looks less like a bubble and more like a real demand-driven market expansion.
And the evidence for that is pretty compelling. You've got leading companies that literally cannot make their advanced chips fast enough to meet the insane demand. So, you see, this isn't just hype. It's a genuine supply and demand situation that points to some really robust growth.
And you really can't talk about the AI sector without zooming in on its most critical player. I mean, NVIDIA's performance gives us some incredible insights into the health of this entire ecosystem.
But there is a big concern floating around out there. The worry is that some of these tech profits might be artificially high. Why? Because maybe companies aren't accounting for how fast their super expensive hardware is losing value.
And this is where it gets really interesting. If you dig into NVIDIA's own financial reporting, they tackle this concern head on. They basically state that ongoing software updates are actually extending the useful life of their chips, which justifies how they're doing their accounting. So, this suggests those profits aren't so inflated after all.
And this just hammers home NVIDIA's incredibly unique position. We're not just talking about a company here. It's a strategic asset. The US government is effectively overseeing the production of these chips because, let's be real, whoever controls this technology has a massive advantage, technologically, economically, and militarily.
Okay, so that's the AI space. But how does that trend fit into the broader economic picture? Let's zoom out now and take a look at the wider market.
Check this out. On November 18th, the CNN Fear and Greed Index hit a reading of just 9. For anyone who follows this stuff, you know that is deep in extreme fear territory. It's a really powerful indicator of market sentiment.
And here's why that number is so important. Historically, when fear gets this high, it's often a sign that the worst-case scenario is already priced into the market. We saw this play out perfectly back in late April. The index hit a 5, and what happened next? The S&P 500 went on a 37% rally. Right now, we're still sitting at 11, which suggests that maybe, just maybe, pessimism has gotten a little overdone.
But here's the puzzle. All this fear in the market is happening right alongside some surprisingly strong economic data. It's like we're looking at a complex, divided economy with a split personality.
I mean, on the one hand, consumer confidence is down, and we're seeing more defaults. But on the other hand, the Atlanta Fed is estimating that the economy grew at a really robust 4% in the third quarter. And at the same time, long-term inflation expectations are cool as a cucumber at just 2.36%.
So here's the crucial takeaway. You've got this massive split. The AI sector is like the engine pulling the entire GDP train forward all by itself, while other parts of the economy are really struggling. Now, the wild card here is potential new government stimulus from both the US and Japan, which could give those weaker areas the boost they need.
Okay, for our final segment, let's pivot and turn to the cryptocurrency space because we're seeing some very similar sentiment indicators at play over there.
And would you look at that? Bitcoin is also telling a story of extreme fear, with its own fear and greed index sitting at 11. What's even more telling, though, are the heavy outflows from spot ETFs recently. That kind of intense selling often signals what traders call a capitulation event. That's the point where everyone who is going to sell finally gives up and throws in the towel. And ironically, that's often a sign that a market bottom is very close.
Now, from a technical analysis perspective, there is a major line in the sand for Bitcoin, $98,000. That level is a massive resistance wall. While the short-term trend is still down, if Bitcoin can decisively break above that level, it would be a huge technical signal that a bottom has been put in.
So, are you starting to see the common theme here? It doesn't matter if we're looking at the AI leader, the broad market index, or the top cryptocurrency. They've each hit a significant ceiling, and they're all struggling to push higher.
So what's the one thing holding all these different markets back? It really boils down to a single word: liquidity. They're all stalling out because they need an injection of fresh capital to break through these hurdles.
And that, of course, leaves us with the critical question for every single investor watching today. With markets pressing right up against their ceilings, where's the next wave of cash going to come from? Will it be fresh government stimulus, a pivot from central banks? The answer to that question is what will likely determine whether we see a major breakout or a painful reversal.